Welcome to the deep dive. Today we're plunging into something pretty fascinating, actually. Financial accountability. Now, I know it sounds technical, maybe even a bit dry, but trust me, it's absolutely vital for, well, trust in our whole economy. And we're going to make it super clear. We're talking about auditing, specifically the sort of detective work auditors do to get what they call sufficient appropriate evidence. And the procedures, the actual steps they take to get it, think of it like the bedrock, the foundation for reliable financial info.
That's a great way to put it, because audit evidence, that's what gives an auditor the confidence to actually form an opinion on a company's financial statements. It's
Right.
really not just about ticking boxes or checking numbers on a page. It's about understanding the story behind those numbers and making sure that story is backed up by solid, verifiable proof.
Mm.
So our mission today is for you to get a real handle on not just what this evidence is, but also why it's gathered in such a specific, careful way. And importantly, how this whole process directly impacts the reliability of the financial data we all depend on, often without even thinking about it.
Okay, let's unpack this then. Audit evidence. What exactly is that? It sounds like it could cover a lot of ground.
It really does. Audit evidence is basically all the information an auditor uses to arrive at the conclusions for their audit opinion. And that's broad. It's not just written stuff or electronic files. It can be things you observe, like physical assets, or even watching how certain company processes work. Auditors gather this throughout the entire audit, right from the start when they're assessing risks, all the way through doing detailed tests. And sometimes, yeah, evidence might come from things like previous audits or maybe the audit firm's own quality control procedures.
Okay, so definitely more than just staring at a spreadsheet. What kind of forms does this evidence actually take? Like tangible examples?
Right. So you can broadly think of it in two main buckets. First, you have the underlying accounting records.
Yeah.
These are the initial entries, the source documents. Think checks, electronic fund transfers, invoices, contracts, the general ledger, journal entries, all that fundamental stuff. Now, these records are crucial, don't get me wrong. Auditors test their consistency, but on their own. They're usually not enough to base the whole audit opinion on.
Okay, so that's the internal stuff. What's the other bucket?
That's the corroborating evidence. This is the information that gives additional support, adds validity to those accounting records. Examples here could be minutes from board meetings, confirmations you get directly from third parties like banks confirming a balance or customers confirming what they owe. It could also be reports from industry analysts, data about competitors, maybe info from specialists the auditor brings in, or even just the auditor's own direct observation or inspection. It's the stuff that helps verify the story the internal records are telling. And it's really important to mention evidence in electronic form these days. More and more. Source documents might just be electronic messages, or whole systems are digital. The tricky part here sometimes is that electronic evidence might not stick around forever. So auditors have to think about its lifespan, how long it will be retrievable when they're planning their work.
That makes total sense. Okay, but here's a big question for me. How much evidence is enough? And how do they know it's the right kind? Because like you said, they can't check every single thing, can they? That sounds completely overwhelming.
You're hitting on a key point. No, they absolutely cannot check everything. The goal is to get sufficient, appropriate audit evidence. And the purpose of that is to provide a reasonable basis for their opinion. Key word there is reasonable.
Not absolute certainty, then.
Exactly. Reasonable assurance, not absolute certainty. Auditors aren't guarantors. They're not promising perfection. And honestly, cost-benefit considerations usually make a 100% check impossible anyway. So the evidence needs to be persuasive rather than totally conclusive. Getting evidence that proves something beyond all doubt just usually isn't practical in an audit context.
Okay, persuasive, not conclusive. Makes sense.
And persuasiveness itself is, well, it's a judgment call. It depends on the nature of the evidence, how much testing they do, the extent, and when they do it, the timing. Now, about the cost thing. While cost is a factor in deciding which procedure to use, auditors absolutely cannot skip a necessary procedure just because it's difficult or expensive, especially if there isn't a good alternative way to get that evidence. This really highlights why professional skepticism and good judgment are so critical.
Right. So you mentioned sufficient appropriate. Let's break that down. What does sufficiency mean here? Is it just about volume?
Sufficiency is about the quantity of evidence, yes, but how much is enough? That's another professional judgment. It's mainly influenced by two things. First, the assessed risk of material misstatement. Basically, the higher the risk, the more evidence you need. Makes sense.
Yeah, logical.
Second, the quality of the audit evidence you're getting. If the evidence is really high quality, really reliable, you might need less of it. But here's a crucial point. even if you have super conclusive evidence about, say, one $500 receivable, that doesn't tell you much about the entire account's receivable balance if it's $1 million.
Right, you need enough coverage.
Exactly. It needs to be sufficient in scope for the balance or class of transactions you're looking at.
Okay, so that's sufficiency, the quantity. What about appropriateness?
Appropriateness is about the quality of the evidence. It means the evidence has to be both reliable and relevant. And it includes all information, by the way, stuff that supports what management is saying, but also anything that contradicts it. Key things determining appropriateness are its accuracy, completeness, authenticity, and also how easily it might be influenced by management bias.
Okay, reliability and relevance. Let's dig into reliability first. What makes some evidence more trustworthy, more reliable than other evidence? Is there like a ranking?
Yes, absolutely. There's a pretty clear reliability hierarchy of audit evidence. Auditors definitely keep this in mind. It goes something like this. From most reliable down, top of the list. Auditors' direct personal knowledge, this is the gold standard. Evidence the auditor gets firsthand through observation, physical examination, recalculating something themselves. They saw it, they touched it, they did the math.
Can't get much more direct than that.
Exactly. Second is external evidence. This is highly reliable because it comes from independent sources outside the company. Think bank confirmation sent directly to the auditor. That's much better than, say, a confirmation the client gets first and then hands over.
Right, removes the middleman.
Precisely. Third, you have internal evidence. This is stuff generated within the client company, like purchase orders, sales ledgers, etc. It's less reliable than external evidence, but its reliability goes way up if the company has strong, effective internal controls over how that information is created and handled.
So good controls make internal evidence better.
Significantly better. And at the bottom, you generally have oral evidence, statements from client personnel. While auditors ask a lot of questions, oral evidence alone is usually the least reliable. It nearly always needs to be backed up by other types of evidence. Oh, and another point. Original documents are always considered more reliable than photocopies or faxes, where alteration is easier.
That hierarchy makes a lot of sense. What about consistency?
Great question. Consistency is key. When evidence gathered from different sources or different types of evidence all point to the same conclusion, that provides much greater assurance. If you get conflicting evidence, that's a red flag. It requires more investigation to figure out what's going on. And if auditors are using information the client produced like a complex report, they need to perform extra procedures to make sure it's accurate and complete. Maybe test the controls over how it was made or tie it back to the original data sources.
Okay, so reliability is all about the source, the independence, the controls, the directness. Got it. Now, what about relevance? How do auditors make sure the evidence, even if reliable, actually answers the right question?
Excellent point. Relevance is critical. The evidence has to directly relate to the specific assertion the auditor is testing, and it has to relate to the correct time period. For example, sending out accounts receivable confirmations. That's very relevant for testing the existence assertion. Does this debt actually exist? The customer confirms they owe it.
Makes sense.
But it's not very relevant for the valuation assertion. Just because the customer says they owe the money doesn't mean they can actually pay it. The auditor needs different evidence to assess if the receivable needs to be written down. The PCAOB standards, which govern public company audits, really emphasize this. Relevance depends on the design of the audit procedure. Does it directly test the assertion? Is it designed to detect understatement or overstatement, and also its timing?
Okay, so once they've gathered all this sufficient and appropriate evidence, what's the next step? Does it always just confirm what they thought initially?
Oh, definitely not always. The results of the procedures are crucial feedback. They might lead the auditor to completely reassess their initial understanding of the risks. They might identify weaknesses in internal controls they didn't expect, or find actual misstatements in the financials through their detailed testing. And if that happens, if controls aren't working as expected or misstatements are found, the auditor has to revise their initial risk assessment. That usually means modifying the audit plan, often doing more extensive or different types of testing. And crucially, auditors have to consider all the evidence, whether it supports management's assertions or contradicts them. Contradictory evidence can't be ignored. It needs to be documented, and usually triggers more work to resolve the issue.
It sounds like there's a ton of judgment involved throughout this whole process. What about the auditors themselves? Are there, like, mental traps or biases they need to watch out for that could unconsciously affect their judgment?
That's a really insightful question, and yes, absolutely. Auditors are highly trained professionals, but they're also human. They need to be constantly aware of potential biases, both unconscious and conscious, that could cloud their judgment or undermine their professional skepticism. There are several common ones. For instance, availability bias. That's relying too heavily on information that's easily recalled, maybe because it's recent or dramatic, instead of considering all the relevant data.
Like focusing on the last thing you saw.
Exactly. Then there's confirmation bias. This is a big one. It's the tendency to seek out or favor information that confirms what you already believe or suspected, and maybe downplay evidence that contradicts it.
So you find what you're looking for.
Sorta, yes. There's also overconfidence bias, where an auditor might overestimate their own judgment or ability, maybe leading them to do less testing than needed. Anchoring bias is another. That's when you latch onto the first piece of information you receive, the anchor, and then have trouble adjusting your view even when new, different information comes along.
Like getting stuck on an initial impression?
Precisely. And one more that's increasingly relevant: automation bias. This is the tendency to over-rely on or blindly trust information generated by automated systems, sometimes without adequately questioning the system's own reliability or controls. Being aware of these biases is the first step for auditors to actively counteract them and maintain objectivity.
Wow. So even the experts have to constantly check their own thinking. Okay, after all this gathering, assessing, and judging, what's the final step in terms of paperwork, the documentation?
Documentation is absolutely fundamental. It's the proof of the work done. Auditors need to document their overall response to the risks they identified. They need to detail the nature, timing, and extent of the procedures they performed and clearly show how those procedures link back to the specific risks they were trying to address. They also document the results of their tests, any conclusions they reached about using evidence from prior audits, why they might not have used external confirmations if an account was material, and crucially, how the final financial statements tie back to the company's underlying accounting records. It's all about creating a clear audit trail that supports their final opinion and shows they exercise due professional care.
Okay, now we've got a solid grasp on what audit evidence is, why sufficiency and appropriateness matter so much. Let's shift gears to the how. How do auditors actually get this evidence? What are the tools in their toolkit?
Right, this is where we get practical. Auditors have a standard set of procedures they use. These aren't used in isolation. They're strategically combined depending on the situation, whether they're assessing risk, testing controls, or performing substantive tests on account balances. There's actually a common mnemonic auditors use to remember the main ones, though it's a bit quirky. See the 5 carat wars.
See the 5 carat wars. Okay, that's memorable. Let's break it down.
Let's do it. Each letter or word stands for a type of procedure. So the first C is for confirmation. We touched on this. It's getting a direct written response from an independent third party about something like a bank confirming a balance or a customer confirming they owe money.
Got it. Confirmation. What's next?
F is for footing, cross-footing, and recalculation. This is basically checking the math, adding columns down footing, adding rows across cross-footing, or redoing calculations the client did, like depreciation expense, can be manual or automated.
Checking the arithmetic. Simple but important.
Very. Then I is for inquiry. This means asking questions. Requesting information from knowledgeable people, both inside the company, like managers, and outside, like lawyers or bankers. Inquiry is used all the time, but remember what we said earlier. It's usually not sufficient on its own. You always need to corroborate what you hear through inquiry with other procedures.
Right. Talk is cheap. Need proof. Okay, V.
V is for vouching. Now, this is one of those key directional tests we'll talk more about. Vouching means starting from an item in the financial statements, like a recorded sale, and going backwards to find the supporting documents, like the invoice or shipping doc. The goal here is to check for overstatement. Did this recorded transaction actually happen? Testing existence or occurrence.
Starting high, going low. Got it.
E is for examination inspection. This means looking at records, documents, or tangible assets, physically examining a piece of equipment, reading the fine print in the contract, reviewing board minutes. It gives good evidence about existence and often about the terms or conditions related to something. Scanning documents quickly for anything unusual is also part of this.
Okay. Next C.
The second C is cutoff review. This is specifically looking at transactions around the year end for inventory, cash, sales, purchases to make sure they got recorded in the correct accounting period. No shifting revenues or expenses between years inappropriately.
Making sure the dates are right. Important. A.
The first A is for analytical procedures. This is a big one. It involves evaluating financial information by studying plausible relationships among both financial and non-financial data. Auditors look for unusual fluctuations or trends that don't make sense, which might signal errors or potential fraud, like comparing this year's gross margin percentage to last year's or to industry averages. They're used during planning, sometimes as substantive tests themselves, and always in the final review stage of the audit.
Looking for patterns and anomalies. Okay.
R is for reperformance. This is where the auditor independently executes procedures or controls that the client originally performed as part of their internal control system. So the auditor literally redoes the client's work, like reperforming a bank reconciliation, to see if they get the same result and if the control is effective.
Testing the client's process by doing it themselves.
Exactly. The second R is for reconciliation. This involves comparing financial amounts from two independent sources to see if they agree. Common examples are reconciling the physical inventory count sheet to the company's perpetual inventory records, or reconciling the cash balance in the company's books to the balance on the bank statement.
Matching things up. Makes sense. Oh.
O is for observation. This means watching a process or procedure being performed by others, like touring the client's facility or watching the client's employees take the physical inventory count. It provides direct personal knowledge for the auditor. But the limitation is it only tells you about that process at that specific moment in time when you were watching, and people might act differently when they know they're being observed.
The Hawthorne effect, kind of?
Precisely. Okay, T is for tracing. This is the other key directional test, the opposite of vouching. With tracing, you start from the source documents, like a pile of purchase invoices, and you trace them forward into the accounting records to make sure they got recorded. The objective here is to test for understatement, making sure everything that should have been recorded actually was, testing the completeness assertion.
Starting low, going high. Okay, that covers 5 carat. What about wars?
Right. W can stand for walkthrough. This procedure actually combines several others. The auditor selects a transaction and traces it through the company's entire accounting system, from initiation to reporting. Along the way, they're inquiring with personnel, observing procedures, inspecting documents, maybe doing some recalculation or reperformance. It gives a great end-to-end understanding.
Kind of a mini audit of one transaction's life?
A good way to think of it. A is for auditing related accounts simultaneously. This is more about efficiency. Certain counts are naturally linked, like long-term debt and interest expense. Auditing them together can be more effective. R stands for representation letter. This is a formal letter the auditor obtains from management at the very end of fieldwork. Management basically confirms certain representations they made during the audit and acknowledges their responsibility for the financial statements.
Management signing off.
Essentially, yes. And finally, S is for subsequent events review. Auditors have to perform procedures to identify events that occur after the balance sheet date but before the audit report is issued. Things like a major customer going bankrupt after year-end or settling a big lawsuit. These events might require adjustment or disclosure in the financial statements being audited.
Wow. Okay, see the 5 carat wars. That's a pretty comprehensive toolkit. You mentioned directional testing with vouching and tracing being key. Can we just nail that down one more time? It feels really fundamental.
Absolutely. It is fundamental because it directly addresses opposite risks, things being overstated versus things being understated. So vouching, again, is backward. You start with something already in the books, the financial statements or ledgers, what's recorded, let's say a revenue figure. You then go back to the source, the sales invoice, the shipping document. You're testing existence or occurrence. Is this recorded revenue real? Did this sale actually happen? It fights the risk of overstatement.
Making sure things aren't made up.
Exactly. Now, tracing is forward. You start with the source document, maybe a supplier invoice indicating a purchase. You then follow it forward through the system to make sure it ended up being recorded in the accounts payable and expense accounts. You're testing completeness. Was everything that happened actually captured? It fights the risk of understatement.
Making sure things weren't missed.
Precisely. Vouching for existence occurrence, overstatement risk. Tracing for completeness, understatement risk. Remembering the direction is key.
That clicks perfectly now. If you're worried about phantom assets or revenue, you vouch. If you're worried about hidden liabilities or unrecorded expenses, you trace. That's a great way to think about audit strategy.
It really is at the core of designing many substantive tests. Now, you asked earlier about external confirmation, and it's worth revisiting that one specifically because it's such a strong procedure when done right. Remember, it has to be a direct written response to the auditor from that third party. An oral response over the phone, while maybe useful as inquiry, doesn't count as formal confirmation evidence.
Written response only. Got it.
And there are two main types. Positive confirmation, which asks the third party to reply whether they agree or disagree with the information given, or to provide the information themselves. And negative confirmation, which only asks for a response if they disagree. Because you don't know if silence means agreement or if they just ignored it, negative confirmations are generally less persuasive evidence.
So positive is generally preferred.
Often, yes, especially for significant items or higher risk areas. And the auditor absolutely must maintain control over the whole process. That means the auditor decides what needs confirming, who to send it to, designs the request itself, considering what they're testing, the layout, how it's sent, and then sends them out and controls the receipt of responses.
What if management tries to block a confirmation? Say they don't want the auditor contacting a certain customer.
That's a significant issue. If management refuses, the auditor first has to ask why and evaluate if the reason is valid and reasonable. They need to think about how this refusal impacts their risk assessment, especially potential fraud risk. Then, they must try to perform alternative procedures to get the evidence they need. If management's refusal seems unreasonable, or if alternative procedures still don't provide sufficient appropriate evidence, the auditor has to communicate that to those in charge, like the audit committee, and figure out what it means for the audit opinion. It could potentially lead to a scope limitation.
Serious stuff. What about the responses themselves? Can they be faked?
There's always a risk of interception or alteration, yes. That's why direct response to the auditor is key. With electronic confirmations, auditors might verify the source through a phone call back or use secure third-party confirmation platforms to reduce this risk. If a confirmation request comes back undelivered or if there's just no response, non-response, the auditor usually follows up, maybe sends another request, and will likely need to perform alternative procedures for those items. Consistent non-responses might also raise flags about risk. And again, if someone calls the auditor to confirm something orally, that's not a formal confirmation. It needs to be written.
Okay. And what if the response comes back but disagrees with the company's records? An exception.
Good question. Auditors have to investigate all exceptions. They need to figure out why there's a difference. Is it just a timing difference between when the company recorded something and when the third party did? Is it a simple clerical error? Or could it be an actual misstatement in the company's records? Potentially even indicating fraud or a weakness in internal controls. Determining the cause of the exception is critical.
So it sounds like auditors have this great toolkit, but they need a map to know where and how to use the tools. How do they decide which procedure fits which financial item? Is there a checklist of what they need to prove?
That's exactly where relevant assertions come in. Think of financial statements as making a series of claims or assertions about the numbers they contain. The auditor's job is to test these claims. And these assertions fall into categories, slightly different for account balances versus transactions. For account balances at the end of the period and their related disclosures, we often use the mnemonic CVAUP, completeness. Are all the assets, liabilities, and equity interests that should have been recorded actually recorded? Valuation, allocation, and accuracy. Are they included at the appropriate amounts? Are valuation adjustments, like depreciation, correct?
Do the assets, liabilities, and equity interests actually exist at the balance sheet date? Rights and obligations. Does the company actually hold the rights to the assets? Are the liabilities truly obligations of the company? Understandability of presentation and classification. Is everything properly classified, described, and clearly presented in the notes?
Okay, CVEURP for balances. What about the transactions during the year?
For transactions and events during the period and their disclosures, we use COVI-EP. Completeness. Have all the transactions and events that should have been recorded actually been recorded?
Are transactions recorded in the correct accounting period? That links back to the cutoff review procedure. Valuation, allocation, and accuracy. Are the amounts and other data recorded appropriately? Existence and occurrence. Did the transactions and events actually occur, and do they pertain to the entity? Similar to existence for balances, understandability of presentation and classification. Are transactions recorded in the proper accounts? Is everything clearly presented and disclosed?
COVI-U2 for transactions. Okay, these assertions provide the map. And earlier you mentioned a key insight: auditors often focus on existence for assets, revenue, risk of overstatement, and completeness for liabilities, expenses, risk of understatement. That seems like a really practical application of these assertions.
It absolutely is. That's a core strategic consideration driven by understanding the inherent risks. Overstating assets or revenue makes the company look better, while understating liabilities or expenses also boosts profits. Auditors focus their efforts where misstatements are more likely or would have a greater impact. And yes, they very deliberately match specific audit procedures to test these specific assertions. For example, If you're worried about completeness, understatement, procedures like tracing from source documents forward or analytical procedures looking for unusual gaps are often effective. If you're focused on existence occurrence, overstatement, procedures like confirmation, observation, inspection of assets, or vouching back from the records are your go-to tools. And for valuation or accuracy, you'll often use things like recalculation or reconciliation. This structured approach, linking risks to assertions to procedures, is really the foundation of effective and efficient audit planning. Hashtag outro.
Wow. Okay, we have definitely gone deep today into this world of audit evidence and procedures. It's really quite intricate. From understanding the hierarchy of reliability, auditors' direct knowledge being best to spotting those potential auditor biases and getting that clear picture of vouching versus tracing, it's obvious that building financial trust is a serious, multi-layered effort.
It really is. And what's fascinating, I think, is how this whole system, grounded in getting enough sufficient and appropriate evidence, is all designed to land on reasonable assurance. It's not about perfection, but about applying critical thinking and rigorous procedures on a massive scale to arrive at a well-supported, independent opinion.
So thinking about our listeners, what's the big takeaway for them in their everyday lives? Why does understanding audit evidence matter beyond the finance world?
That's a great question. Think about it this way. The next time you read a news headline about a company's fantastic earnings, or maybe see an organization making big claims about its performance or impact, pause for a second and think, what kind of evidence might actually support those statements? Understanding these core principles, sufficiency, appropriateness, reliability, relevance, the procedures used to check things, it equips you to be a more critical consumer of any information. It helps you ask better questions like, how do they know that? Or what's the proof? It's not just about financial data, it's about evaluating claims in general.
That really elevates it, doesn't it? From a technical audit topic to basically a masterclass in critical thinking and information literacy that we can all use every day. How to weigh evidence, consider the source, look for confirmation.
Exactly. It's about being less likely to take things purely at face value.
That is a powerful thought to end on. Thank you so much for walking us through that complex world. And thank you, our listeners, for joining us on this deep dive. We hope you feel more informed, maybe a bit more skeptical in a good way, and definitely more curious about the evidence behind the claims you encounter.